Hi there. Let's take a look at what's happening in the broader end of the market. While the Nifty is subdued, a pressure of about 0.5%, the Nifty small cap index is going all out, outperforming the breadth of the market, 0.3% higher. Whereas the Nifty mid cap that's also giving into some pressure and is seeing a mild hint of negativity right now. But shifting focus, let's talk about one stock, that's Blue Star, that's doing really well in trade today. A slightly more than 3.5% uptick coming in on the stock right now. This on the back of the management outlook that Q4 is expected to be a much better quarter, where they're expecting a good summer this time around as well. So let's get interacting with the management of the company. We have Mr. V.S. Advani, the Chairman and Managing Director at Blue Star, joining us on the show. Mr. Advani, hi, morning. Good to be speaking with you. Talk to us about this outlook that you've given the street. The street is taking it really well too. Now, with the first 3 quarters of FY26 been challenging for you, you are now seeing signs of market revival. How confident are you about the strong summer-led recovery in RAC segment, particularly in Q4, since this is something that you have mentioned in the release?
Very much for having me today. We've been talking about basically an uptick in our industry over the last few years. We expect a CAGR of about 15% over a period of time. We will always have down years like the current year because of the washed out summer or bad summer. So if you look at the 9 months till date, you'll see that the industry has degrown 13%. Blue Star has degrown by 9%. We expect the full year degrowth of the industry to be around -10, and for Blue Star to be -5. So this year is a difficult year, but there are some green shoots and some positive outlook. Number one is, I think you're aware that we had a BEE table change happen effective Jan 1. With old stock going into the market, and now, of course, all the new buying will start on the new table change. So new products in the market, we're expecting there will be an uptick in demand as the summer comes back. Of course, I do want to caution that there is excess inventory in the field even today. While Blue Star inventory may be higher by 2 to 3 weeks in comparison to what it should be, market inventory may be higher by about 5 to 6 weeks. So certainly we do need a hot summer, a good summer to clear out the old inventory and then to see primary sales pick up. But we're optimistic about the same.
Right, that's good to hear. But let's talk about your margins then, because what the street was expecting and what you have reported, there's a difference and a positive difference as well. But help us understand what led to that, from where and what factors helped you grow your margins, and what's the outlook going ahead in Q4?
Sure. So I think for that, we need to look at our segment results. So if I look at segment 2 first, which is our room air conditioner and refrigeration business, there you would actually have seen an improvement in EBIT margin from 8.1% to 8.5%. We're actually very happy with this industry leading EBIT margin. You would have seen from other publicly traded companies showing much lower margins. We actually prioritized profitability over volume in this quarter, which is why segment 2 you would have seen flat revenue growth, but an improvement in EBIT margin. So we're happy with that. Obviously, as we get into the new quarter, new table change, new products, those prices are going to be higher because efficiency rates have gone up. So we do need to manage our margins going forward. The issue in the quarter has actually been in segment 1, which is our MEP business and commercial air conditioning business, where you would have seen EBIT margin actually drop from 7.6% to 6.8%. So I'd like to explain that. You may know that our MEP business operates in 4 verticals. There's the commercial buildings, factories, data centers, and infrastructure. In this quarter, we've had much higher revenue from the infrastructure vertical. Infrastructure projects tend to be lower margin, and therefore it's a business mix issue that has caused this drop in EBIT. We do expect infra business to continue to be at a higher level for the next couple of quarters. So you'll see margin pressure in segment 1 for a couple more quarters, and then we'll regularize it. So I think on a long-term full year outlook, next year will also be positive for segment 1 in terms of EBIT margins.
Okay, so that sounds good. Mr. Advani, the RAC segment, the channel inventory was built ahead of this energy label change that we've seen with effect from 1st Jan. So that could have been a fillip this time around. But do you expect this to pull forward demand or sustain momentum into the peak season as well?
Yeah, so like I mentioned, we have industry inventory levels are high. They are about 9 to 10 weeks, which is about 4 to 5 weeks higher than they should be at in a normal year. So we are expecting consumer demand to come in strong to first clear out the earlier inventory, and then we'll be pushing primary sales into the market. Given that this last year was a washout, not only was the summer a washout, but also, because of the delay in the GST announcement, we lost about 6 to 8 weeks of sales in Q2 as well. So there is pent-up demand for sure. There is latent demand there, as we know. We just need the summer to kick in, and we need a week of hot weather. And I think you'll begin to see all this inventory clear out. So we remain positive about outlook for this category.
Right, but let's talk about your net borrowings. We see that they have risen versus what you have reported last year. Is this linked to working capital for the peak season or some capex investments?
Yeah, so you would imagine that working capital has been much higher than we would have wanted. It's been a tough summer, and therefore working capital is higher by about 500 to 600 crores. So that will get cleaned out as we get through Q4. We have had to also temper some capex as a consequence of that, because we are a ROCE focused company, as you know. Return on capital employed is about 26% as of now, and we've aimed to close the year at 30. So we have tempered down some capex without affecting our capacity expansion plans. However, as soon as we clear out the inventory, we'll resume our plan of capex. So I think directionally, this level of debt we're very comfortable with. You've seen a debt equity ratio that's very comfortable. And since we're in investment mode in R&D, in manufacturing, in digitalization, we expect debt levels at this level.
Okay. And Mr. Advani, the release also mentioned that the company's US and Europe expansion is progressing well, even though we have some tariff uncertainty right now. What's the outlook on the international business, and are you looking at foraying deeper into European markets now that the India-EU FTA has been signed? Are you going to have any advantage from that?
Yeah, so thank you. So we're extremely optimistic about the international business. We operate in the Middle East in our own brand, and that business is doing well. We have a custom design and manufacturing business for the US and Europe. The US has been a challenge because of the tariffs at 50%. We have to wait to see what happens with that. As far as the EU is concerned, you know that the tariff until December 31 was actually a 0% tariff. That has actually gone up to 2.7% because the EU has withdrawn the GSP for India. But with the new FTA, that'll come back to zero. So I don't think it's really a benefit because of tariff, but I think the India-EU FTA builds a lot of confidence in India manufacturing, India supply for EU customers. So I think they will now look at India much more seriously in comparison to Korea or China or Vietnam. And that's the business that we're competing in. So we're optimistic about the outlook now that the FTA has been signed.
Okay. And lastly, Mr. Advani, I have to ask you, the union budget is just a couple of days away. Are you looking forward to some announcements in terms of further boost to consumption? Any expectations you have from the budget?
No, I think they've done a lot for consumption this year. I think it'd be unfair for us to ask for more. However, I think we are hoping for more reforms. I think as we can get more reforms, we can become more competitive. Finally, it's about competitiveness. It's about global competitiveness. And so I do hope that we do continue the announcements. One thought I have is while Blue Star has increased our R&D spend, as you can see, to about 2% of revenue, up from about 0.5, 0.6% a few years ago. We will, of course, continue to increase that spend. But as an industry, I think we are underinvested in R&D. So if there is any policy or reform that promotes R&D over and above what they announced last year in the budget, that I think would help the entire industry.
All right, and we look forward to that. But with this, Mr. Advani, we let you go. So good having you on the channel today. Thank you so much for your time.
Thank you. Thank you.
All right, but with this, viewers, it's time now to slip into a very short break in this edition of Mid Cap Masala. Don't go anywhere. We'll be right back with more on the other side.